into Market Fatafat, where we're getting you buzzes on the back of news flow or technicals. Now we have Kanishka joining us with Honasa. Honasa Consumers is one of the stocks that is buzzing away in trade on the back of solid numbers. In fact, the entire new age tech is buzzing, whether it is Honasa, whether it is Paytm, whether it's Nykaa. But take us through the fine print of why Honasa is buzzing today.
Absolutely, Ankita. So like you said, Honasa has posted a solid Q1 with revenue in line, up about 7.5% on a year-on-year basis, while profit and margin, they came in line with estimates. Net profit rose to 41 crore rupees and EBITDA beat forecast at 45.8 crore rupees. Margins, they also improved very sharply on a sequential basis to 7.7% from 5.1% earlier. Now, this growth was driven by double-digit gains in focus categories like face wash, shampoo and face serum, with the Dermaco's face cleanser crossing 100 crore rupees in ARR. Offline distribution and modern trade channels, they also grew 20% on a year-on-year basis. Now, talking about brokerages, they somehow are split. Jefferies has a buy call with the target price of 400 rupees. Goldman Sachs is neutral with the target price raised to 295 rupees from 275 rupees earlier. JP Morgan, meanwhile, is underweight on the stock, but the target price has been raised to 235 rupees from 197 rupees earlier. So while execution and profitability are improving, brokerages differ on upside potential for the stock, making it a close to watch today. As we can see, it's up about 8%, more than 8% at this point on the back of that solid Q1 number.
Solid Q1 numbers, and the stock is soaring in trade today, up 8% as we speak. But on the technical side, we are also now joined by Mr. Nilesh Jain, Head Derivatives and Technical Research at Centrum Broking. Nilesh, afternoon, and Dr. Reddy's, that's the first stock that you've picked for us. Tell us, what do charts indicate for this counter?
Very good afternoon to you. Absolutely. So, Dr. Reddy, in fact, not only this particular stock, across all pharma stocks today, we are witnessing a good momentum. Nifty Pharma Index looks like a short-term bottom out, and we are expecting a follow-up move to continue in across majority of the large-cap pharma counters. So as far as Dr. Reddy is concerned, today it has reclaimed its 200 exponential moving average. We have seen a strong rebound from the lower levels. Looks like it is heading towards 1275 to 1300 levels on the upside. So it's a buy at present. Buy on decline should be the strategy, keeping a stop loss below 1220. Immediate target would be 1275 followed by 1300.
1300, that's the ultimate target price for Dr. Reddy's. But now let's also put the spotlight on Titagar Rail, and this one is also reacting to its numbers, where revenue saw a downtick of nearly 25% on a year-on-year basis. Margins, meanwhile, were steady at about 11.1% versus 11.3% that the company reported in the previous quarter. As far as segment-wise performance is concerned, freight rail systems revenue declined, and that led to the overall downtick on a consolidated basis as well. New orders booked during the quarter stood at about 2,470 odd crores. Overall order book position also continues to remain very solid, and the company is confident of maintaining their EBIT margins in freight rail segment in FY26, and that rail segment margins are expected to remain stable in the full year FY26 as well. So some management commentary continues to remain very positive. In fact, we also spoke to the management, where Titagar Rail said that it will have a few good quarters ahead. Umesh Chaudhary of Titagar Rail Systems told ET Now. He also talks about the shipbuilding business. Let's go across and listen in to what he had to say.
Our foundry expansion is also coming in track within this quarter and the next quarter. So whatever castings that we were buying from outside in order to achieve the target run rate of say 900 to 1,000 wagons, that also would be completely will become self-sufficient for the foundry capacity as well. We have seen good traction of inquiries coming from private sector customers of wagons. The shipbuilding business is going to continue in the new company and is going to grow in the new company. And the government has very clearly articulated that shipbuilding is a thrust sector for the government, both for infrastructure purposes, but also for nation building purposes. And therefore, having built more than 35 vessels in the last few years for the Navy, for the National Institute of Ocean Technology, for the Coast Guard, and all of that, we thought that it will be a national waste and a shareholders waste for the company.
All right, moving on to the next counter, and that is Alchem Lab. Rabinder, tell us why have you picked out Alchem for us?
Alchem Lab is in focus on the back of their brokerage upgrade, where ICICI Security has come out with a note and they have upgraded the stock to buy from add rating and hike target price rupees 6,065 from earlier target price rupees 5,900. And they say that the Alchem has that all-round beat driven by the traction in India and curb in overseas, and they expect Alchem to witness a revenue CAGR of 10.6% and nominal margin expansion of approx 65 basis point to 20% over FY25 to 27. And ICICI Security also say that they have increased their EPS estimate by approx 4% for the 26 and FY26 and FY27 to factor in the better growth across India and other international markets. And Jefferies has also come out with a note where they have upgraded the stock to buy from underperform rating and hike target price rupees 6,000 as compared to earlier target price rupees 4,460. So back of the upgrade from these two brokerages, Alchem Lab is in focus and the stock is holding a gain of more than 4.5%.
All right, so that's Alchem Labs on the back of brokerage note. But Natco Pharma is another counter from the pharma pack that has reported its quarter one numbers. It has reported a 22% year-on-year decline in the consolidated net profit. On the back of pricing pressure, the profit stood at 480 crores for quarter one of FY26 compared to 668 crores in the same quarter last year. Now, the US product portfolio and the higher R&D expenses have impacted the performance as well. Revenue from operations also slipped 2.5% on a year-on-year basis to 1,329 crores, while the EBITDA fell 32% to 519 crores from 764 crores a year earlier. The operating margins also contracted sharply to 39% from 56% last year, reflecting increased investment in the high-value research products. Now, the company said that the US business has remained under pressure due to competitive pricing, even as it continued to channel resources into strategic R&D initiatives aimed at long-term growth. Now, the company said that the US business remained under pressure and the pricing competitiveness is likely to continue. But on the back of quarter one results, we do see some buying coming in at this juncture. At least from the day's lows, Natco Pharma has really picked up and seeing some buying. It's gaining right now in trade with gains of 1.5%.
Okay, so that's the stock which is gaining nearly 1.5% in trade, but shifting focus to Nykaa then. And this counter is also up nearly 5.5% in trade. Kanishka, strong set of numbers, and what's aiding the move? Tell us more.
Absolutely. So Nykaa's numbers were largely in line with revenue, up 23% on a year-on-year basis. EBITDA, that also rose about 46%. Margins improved 102 basis points to 6.5%. The miss, however, came on profit at 24.5 crore rupees versus the estimate of 33 crore rupees. The personal and the beauty and personal care segment that led the charge with revenue up 24% on a year-on-year basis, with GMV that was up 26%. House of Nykaa Beauty that saw 70% jump in GMV, whereas the fashion business that also continued to grow steadily with the GMV coming in at up 24.5%. Apart from that, Nykaa has also announced that it will fully acquire Nudge Wellness, strengthening its wellness and micro-cosmetics play. Brokerages, however, they remain split. Jefferies with a buy call, target price at 250 rupees, up from 240 rupees earlier. Citi has a sell call, however, with the target price that raised to 175 rupees from 160 earlier. On the other hand, JP Morgan is underweight with the target price of 186 rupees. So a steady quarter operationally, but the street remains cautious on valuations. But right now, as we can see the stock is up more than 5% on the back of the solid Q1.
Okay, so very strong set of numbers, and Nykaa is gaining on the back of that. But another counter which is in focus in the back of its results is ONGC, and it reported largely in line set of numbers. Revenue for the quarter gone by on a standalone basis saw a solid uptick. EBITDA came in at 18,120 odd crores, which was an uptick of nearly 1% on a year-on-year basis, and PAT also rose by about 10 odd percent. So that's the kind of movement that we have seen. Standalone crude oil production rose 1.2% YOY. Natural gas production also saw a steady uptick, while overall oil and gas production was flattish on a year-on-year basis. But largely in line with what the street was working with, no major negatives. The stock is holding up with gains of nearly 1.5% as we speak.
All right, that's ONGC that's holding up with gains of 1.5%. But Nilesh, coming to you for Hero Motor. Now, Hero Motor has been doing pretty well for the past few trading sessions. In fact, today also it's up in a way more than 2.5%. On the charts, does the bullish trend remain intact for Hero Motor?
Right. So if you just pull up last 6 to 8 months chart, you can clearly see the stock has formed a big rounding bottom formation on the daily time frame chart, and it is also on the verge of a major breakout that is placed somewhere around 4,800. Looking at the recent momentum that we have seen, the stock also gave a breakout from a small time frame consolidation at the level of 4,600. So the overall setup looks strong. It has been one of the underperformer within the auto two-wheeler space specifically. So we are expecting a strong momentum to continue from here further towards 5,000 to 5,200. So these are the little positional target, and 4,550, 4,600, which is acting as a strong support zone. So that should be the stop loss. And this particular counter, as far as from August series perspective is concerned, I think 5,000 plus kind of levels we can expect.
Okay, so 5,000 plus levels, that's the target coming in for this counter. But let's also put the spotlight on Paytm then. Rabinder, they've received RBI nod for aggregator payment license. Tell us more and the stock movement as well.
Well, yes, Paytm is in focus where where RBI has granted in principle authorization to Paytm Payment Service Limited for a payment aggregator license, and Paytm Payment Service Limited is a wholly owned subsidiary of the 197 Communication Limited. And RBI letter mentioned that the merchant onboarding restriction placed on the PPSL in November 2022 have been withdrawn, but the firm has been authorized to undertake a system audit, including one for security, cyber security, and the audit report will have to be submitted to RBI within 6 months. So back of this news flow, Paytm is in focus, and the stock is holding a gain of approx 3.5%, and stock is also trading at its 52-week high.
All right, that's Paytm that's trading at its 52-week high. On the charts, how does it look to you, Nilesh? Paytm, it's now got an RBI nod, but on the technicals, what do you see for Paytm?
See, multiple positive development we can see in this particular stock. First of all, the stock is constantly forming a high top and high bottom formation, and not only that, if you see, it has given a multi-year breakout as well after 2022. This is the first time the stock has hit a highs above 1150 mark. So it is a multi-year breakout candidate. We are still positive on this particular counter towards 1300 plus. So these are the positional target. Buy and decline should be the strategy. The recent spurt that we have seen, due to that, the risk and reward is not favorable to chase this particular stock at high levels. Better apply a buy and dip strategy. Wait for some meaningful decline towards 1120, 1100. That can be a good entry point. Keeping a stop loss below 1080. Paytm is a buy for positional target of 1250 to 1300.
Okay, so 1250 to 1300, that's the target price coming in for Paytm. The stock is already up 5.5% today. But shifting focus to HAL then, Hindustan Aeronautics, again a strong set, Kanishka, isn't it? The stock is up over 3% today.
Absolutely. So HAL has posted nearly 11% year-on-year jump in its consolidated revenue, coming in at 4,819 crore rupees. Net profit, however, that saw a decline of nearly 3.7%, but EBITDA, that surged 41%. That's the key highlight, with margins expanding 462 basis points year-on-year to 21.6%. Brokerages remain bullish. Nuvama, that has set a target price of 6,000 rupees for the stock, calling it a promising start of the year for HAL, citing a 1.84 lakh crore rupees order book and 4.6 lakh crore rupees pipeline over the next 7 to 8 years for this company. The broker sees nearly 21% revenue CAGR over FY25 to 28. Motilal Oswal also expects faster Tejas aircraft deliveries. It has set the target prices at 5,800 rupees. Now it says 24% revenue CAGR and strong margins near that 28% to 30% levels are possible through FY27. So both these brokerages, they see sustained growth backed by big defense orders and healthy returns over the next few years.
Okay, so that's that stock for you. But let's also put the spotlight on PB Fintech then. Nilesh, you've picked up this counter on the technicals. Tell us, what do charts indicate for Policy Bazaar?
Right, Asisha. So this particular stock recently gave a breakout from its falling channel. and it has also crossed its 50-day moving average. Structure wise, look strong for further momentum towards 1900 to 1950. The momentum indicators and oscillators are very much in the buy mode for this particular counter. So looks positive from short to medium term perspective, and 1800 is acting as a very strong support as of now. So one can play on the long side for immediate target of 1900, followed by 1950 to 2000 as a positional target, and 1800 will be the stop loss.
All right, that is PB Fintechs on the chart. But with that, it's time for us to slip into a short break. Don't go anywhere. After the break, we get you more buzz on the other side. Stay tuned.
Welcome back. You're still tuned into Market Fatafat, a show where we discuss all the stocks that are buzzing in trade. Let's now put the spotlight on Max Healthcare. This one reported its numbers just a couple of hours ago, and the stock saw a knee-jerk reaction after it reported its numbers, although it has again recovered from the lowest point of the day. Revenue for the quarter gone by stood at about 2,460 odd crores, which is an uptick of nearly 27% on a year-on-year basis. Margins, meanwhile, have also declined a tad bit. They've come in at 24.9% versus 25.8% that the company had reported same time last year. So on a year-on-year basis, margins have contracted by about 90 odd points. Profit, meanwhile, has risen by about 17% YOY to come in at 345 odd crores. We are awaiting some more management commentary, but for now, on a year-on-year basis, it's a good set, and the stock has also recovered from the lowest point of the day, sitting with gains of nearly 0.5% as we speak.
All right, that's Max Health sitting with gains of 0.5%. But coming to you, Rapinder, you picked up Astral for us, a brokerage upgrade coming in. Take us through the details of that.
Well, yes, Astral is in focus, where ICICI Security has come out with a note, and they have upgraded the stock to buy from hold rating at target price of rupees 1540 as compared to earlier target price of rupees 1504. They say that Astral has announced the acquisition of Nextcalin Chemical, which will manufacture CPVC resin from Q2 FY27, and thus enabling the company to backward integrated and the more cost competitive. And they believe that this backward integration could structurally improve the growth margin and profile for the company of piping businesses. So back of this update, Astral is in focus, and the stock is holding a gain around 1%.
Okay, so Astral, that's holding up with gains of nearly 2% in fact as we speak. But let's also put the spotlight on HDFC Life then. Nilesh, why have you picked up this counter today?
See, within insurance pack, this particular stock recently it has formed a very good base formation. So we are very much bullish on insurance space as a whole. Specifically life insurance counters like HDFC Life and SBI Life both. So HDFC Life today, it has surpassed its 50 DMA, that is placed somewhere around 761, and it has also given a good breakout from its double bottom pattern. So we are expecting further momentum to continue towards 800 to 820. Looking at the market volatility, insurance space is acting as a defensive space, and margin of safety looks slightly better in the insurance space. So it's a buy for upside target of 800 to 820. 760 should be the stop loss.
All right, that's HDFC Life on the charts. But coming to you, Kanishka, you picked out Interglobe Aviation for us. Tell us, why have you picked out this particular counter and why is it in focus?
Absolutely. So, Indigo is in focus because the aviation regulator DGCA has imposed a new show cause notice on Indigo for alleged lapses in simulated training for nearly 1,700 pilots. Now, as per reports, critical airfield training required for challenging airports like Calicut, Leh and Kathmandu was conducted on non-qualified simulators. Indigo has confirmed receipt of the notice and says that it is reviewing the matter and will respond within the stipulated timeline. The DGCA action follows scrutiny of training records and responses submitted by the airline last month. So that's why Interglobe Aviation is in focus today. However, despite the negative news flow, it continues to trade higher, about 0.4% higher at this point.
Okay, so that's Interglobe Aviation for you. Negative news flow coming in on that counter with respect to regulations. But shifting focus to L&T Finance then, Nilesh, where do you see the stock headed?
Right, so L&T Finance is another stock that is looking strong on the back of a rebound that we have seen today. It has again crossed its 50 DMA. The recent correction has given a good opportunity in this particular stock. We are expecting a further follow-up move to continue towards 205 to 210 on the upside. The risk and reward looks attractive at current level because the stock has a very strong support at 196. So keeping a stop loss below 196, L&T Finance is a buy for upside target of 205 to 210.
All right, with that, we're completely timed out in this edition of Fatafat. Kanishka, Rabinder and Nivesh, thank you so much for taking the time out and taking us through all the stocks that are in focus today. But besides these stocks, there is a counter that is in focus today, and that is Nykaa and Honasa both have reported their quarter 1 numbers. The new age consumer players are soaring in trade post they recorded their numbers. My colleague Snehi is now joining us to help us understand what has worked for them and what are the brokerages really penciling in for these two counters. Take it away, Snehi.
Well, absolutely. Two stocks that are up in a way, Nykaa as well as Honasa Consumers on the back of its quarter 1 earnings. Both of them very good set of numbers coming in. Let's take it one by one. Understand first what worked for both of them individually. Nykaa, revenue, EBITDA and margin in line with our estimate. The overall GMV came in at 4,182 crores, which is up 26% year on year, in line with our estimates. What really pushed the stock to do well this time around in quarter 1 was the BPC revenue. That was up 24%. We were expecting an 18% growth. So beat on that front. Fashion GMV also up 24.5%. We were expecting a 20% growth. So big beat on that front as well. While we're talking about the fashion segment, the fashion net losses have reduced on a year-on-year basis to 27 crores from 30.3 crores last year. So these were all the factors, the top factors among other positives that worked for Nykaa this time around. Let's shift tail and talk about Honasa consumer revenue in line. PAT EBITDA margin beat versus our estimates. EBITDA margin expansion has been healthy. Focus categories like face wash, shampoo, serums, they've seen double-digit year-on-year growth. There's been 100% year-on-year growth in face cleansers, and this is the third category to reach an ARR of 100 crore plus. The revamp in the general trade strategy, remember that they did last year, has reaped into results. Modern trade and offline retail distribution are both up 20%. Direct distribution strategy is up 50% year on year, and that has driven a 50% increase in retail outlets build in quarter 1. Now let's come to the guidance front. For Nykaa, they are on track for their fashion EBITDA margin break even in FY26 this financial year itself. They also say that beauty vertical has room for more profitability, and they see opportunity in health and wellness supplements, and hence the acquisition of Nudge Wellness. For Honasa, they expect double-digit value growth for the remainder of FY26, EBITDA to be maintained between 7 and 8%, and they expect larger brands to reach the mid-teen EBITDA margin by 4 to 5 years. Lastly, what the brokerages are making on both of these stocks: for Nykaa, Jefferies maintains a buy, Citi maintains a sell, Axis Capital and Nuvama have all maintained buy, but barring Nuvama, all of these other brokerages have hiked the target prices as well. As is the case for CLSA, wherein for Honasa, wherein CLSA in fact has upgraded the stock to an accumulate from hold, hiked the target price. Jefferies continues to be positive, Goldman Sachs has maintained neutral, JP Morgan has maintained underweight, but even both of these brokerages have hiked the target prices nominally. So that's the take on the quarter 1 of both Nykaa as well as Honasa, and what has gone right for both of them this time around.
Thanks so much for joining us with all those details, but that's all the time we have on this edition of Market Fatafat. Closing trades coming up next.